Hello and welcome to this edition of Macro and Markets. We have the full set of corporate results which has been announced, and we see a divergence in corporate performance that has played out at various levels. First, there is a divergence between the top line performance and the bottom line of the companies. Secondly, there is a lot of intersectoral divergence. Third, the divergence between the near-term forecast of earning and the future forecast remains. If we see the top line growth of the Nifty 50 companies, they have degrown by close to 2%. If we look at the broader set of 4,000 plus companies for which CMI maintains the data, that has also degrown by a similar magnitude. The profit growth of these larger set of companies have also degrown on account of absorption of the losses of the telecom sector due to the Supreme Court ruling during the quarter. If we look at the Nifty 50 companies, however, they managed to register close to 8% growth in net profit, but here almost 90% of it is accounted by the corporate banks and a few well-performing NBFCs. Similarly, the drop in the top line is explained by a sharp decline in the auto sales and a correction in the prices of the commodities, that is the metals and the oil and gas sector. So whether it is performance or underperformance, the divergence has played out in the corporate sector, and it gets reflected in the market performance, where we see a lot of divergence among companies which are valued high at present. So the debate which is going on between the divergence of valuations of a few large cap companies can partly be explained by the divergence in the underlying corporate performance. One thing that has helped in the quarter is the tax cuts that has helped across the board a large number of companies. In fact, because of the corporate tax cuts, the number of upgrades and downgrades ratios are more or less even now. Therefore, the earnings downgrade cycle have possibly halted, and we expect the FY20 earnings growth to stay at 10 to 12% range, and FY21 is likely to register double of that growth. So we have turned overweight on equity since the corporate tax cuts, and that theme has played out well. In terms of the large cap versus mid cap, for a large part of 2019, the large cap outperformed, but since the tax cuts, the performance of the two are more or less even. In terms of the number of weeks, the large caps have outperformed the mid caps. So in the equity market, an overweight asset allocation strategy, which is little tilted towards large cap, and with a concentrated bet on the banking and sector and the well-performing NBFCs, have played out quite well. In the fixed income market, we are overweight on that asset class for the third successive quarter now. That strategy has also worked well because of the drop in yields. But if we look at the credit spreads, that has remained elevated for large part of 2019, but it has remained somewhat stable. Of late, the credit spread have shown first signs of narrowing. And if the reported measure by the government comes through to address a large segment of stressed asset by NBFCs, we feel the corporate spreads have room for further narrowing. However, the term spreads have widened as the yield curve has steepened, and it has steepened partly because the transmission has worked at the lower end of the curve, while at the higher end, the concerns over the fiscal deficit has kept it relatively resilient. But the steepening of the yield curve provides continued duration opportunities. Therefore, the fixed income strategy of safer instruments with a focus on reaping the opportunities at the mid duration is the strategy that has played out well so far. We remain overweight on both equities and fixed income, therefore. Thank you.